Hey, good afternoon, everybody. Going to go over our Forex trades for today, Tuesday, November 3rd. Pretty slow day again without much economic news out there. We did get factory orders, which missed estimates by 0.1%. Not a big deal there. We do have Mario Draghi speaking later this afternoon, so that'll be interesting to watch as far as the euro is concerned and the whole European economy. We did have two trades, pulled out 11.0 pips. One was a swing and one was a scalp. We'll go over them in a minute. Just wanted to touch base on something that Bill Gross came out this morning with a letter to investors over at Janus. And of course, the commentators on TV are, I don't want to say making fun of it, but they're kind of trying to talk down Bill Gross, saying that he's getting older now. He left PIMCO because he's losing it or whatever. And what his letter this morning to investors was a little on the drastic side. But funny thing about it is, it's very similar to what we've been saying about quantitative easing and zero-bound interest rates for close to 2 years now, maybe even more than 2 years, which you could see from, I'm sure you've heard on the videos. But what he's basically saying is that zero-bound, I'll just read some of his quotes from his letter. He says, zero-bound money, quality aside, lowers incentives to expand loans and create credit growth. So when he says zero-bound money, quality aside, he's talking about where we are now with as far as interest rates and the flattening of the yield curve, which is between, say, a 2-year piece of paper, a treasury paper, and a 10-year treasury paper. The yield curve has flattened so much that it's basically not creating or not giving the companies and the ability to help them make money. And I'll go on, and he talks about that a little bit. He says the post-Lehman experience and lost decades of Japan show that households don't spend more during times of zero-bound rates. So it almost makes sense. If you have zero-bound rates, and you and I, we put money in our bank, you put money in a savings account, you're not getting anything for return. So you're going to be less inclined to spend that money because you're afraid of what the future holds. You're afraid that you're not receiving any money back from a savings account, even if you're buying a bond with it. The yields are so low that so therefore you're going to be a little bit more on the defensive side as far as spending. He says corporate profit margins resulting from maturity extensions are squeezed, basically the flat curve. So what corporations try to do is they try to leverage between, or I should say capture differences between on that yield curve between a 10-year piece of paper and a 2-year piece of paper. Obviously, the 10 years is going to be yielding more, but now with the curve so flat, they can't do that. So it's actually hurting their profit margins because a lot of companies have a lot of cash on hand. Just like you and I, they don't want to spend it, and they're also not receiving anything in return as for their investment. So they're stuck in the same situation as an individual person. He says his primary thesis is that capitalism doesn't function well. Profits are stunted if short and long yields are at the zero bound. Again, the flattening yield curve. He used the word capitalism. I don't know if I'd go so far to use that word, but maybe he could say, the finance area of capitalism, right? I mean, I don't know. I mean, I guess I guess capitalism. You could, I guess it would encompass the entire economy in the United States. Where it's not a socialistic type of a country. So I don't know that the word. He could have chose a different word. I'm going off exactly what he's said here. With zero-bound interest rate policy, central banks, they zero out the cost of time and bid up asset prices, but fail to create new assets in the real economy. That's dead on to what we've been saying. We've been saying for years now with zero bound rates, with this QE, it's proven it hasn't created jobs. It's zero bound rates. All it's doing is creating financial engineering. It's not creating the good inflation. It's not creating hardly any inflation at all, but it's not creating good inflation that higher rates would create. A simple example would be if you're a county, county of New York or whatever, and you want to issue some bonds because you got some work you're going to do. You're going to, repair some bridges, road work, toll booths, whatever. Schools, building schools, refurbishing schools, all this stuff. There's no appetite by investors. So you're the municipality, you're going to go to an underwriter, one of the big investment firms, and you're going to say, yeah, we're interested in issuing X amount of dollars because we want to do these projects, which in turn creates jobs, right? Because they have to hire the people to do the work. And the big banks say, well, Mr. County, we'd love to take your business. We'd love to underwrite your issue. Unfortunately, you're going to have to, you're going to be offering, good for you that you're going to be offering such a low rate because of the interest rate or environment in, but unfortunately, it's going to be hard for us to sell this issue. And that's what's going on around the entire country. The investors, the investors don't have the appetite to lock up their money in a 10, 15, 20-year piece of paper from some municipality somewhere and getting 2.5%, 3% on their money when they could put it in risk assets, which they're doing. That's why the stock market is so high. But the Fed obviously fails to recognize this, and that's exactly what Bill Gross has been saying, and that's what we've been saying for the last few years. He says the Fed now holds over $2 trillion in long-dated treasuries and mortgages that can be switched into 2 to 5 year paper. This is the ingenious part. He says, so he's basically saying the Fed's got over $2 trillion that they've put in 10-year, basically long-dated, 10 or more years, long-dated treasuries and also, mortgages and other type of obligations, that they could switch that out to 2 and 5 year paper. So basically sell that longer dated maturity, and so they own so much of it that they could sell it, and they can actually drive up the yields on those longer dated maturities and buy the 2 to 5 year piece of paper, the lower, and drive down those yields, therefore widening that yield curve, right? So it's not so flat. And he basically says it would be steepening the yield curve and benefit savers, liability-based businesses, and the economy itself. And that's exactly what we've been saying. We were saying just to raise rates. This is a way the Fed could raise rates without actually raising rates, if you understand. Like, without actually raising the Fed funds rates. They could go and they could do it through financial engineering, but they could create, and now you're going to have people saving money, and they're actually getting money, so they're a little bit more inclined to invest. It's more of a normal interest rate environment, which we're all geared for, especially the older you are, the more geared, because this is what you've known. You don't know zero bound rates. So you're getting more to normalcy, and you got the municipalities with the higher rates, and then you're going to have some appetite from investors, and it is a change cycle. So what we've been calling for is for the Fed to raise rates. This is an ingenious way of doing it, but yet the people on TV, they kind of talking it down, unfortunately. But it very interesting. One last thing I want to touch base. Goldman Sachs lowered third quarter GDP forecasts yet again. They actually bumped it up, I think, one day last week, but they lowered it today after the factory order miss. But not a big surprise there. Let's go over our two trades. Pulled out 11.0 pips on a size adjusted basis. First, what you're looking at here is pound to Aussie. We were long from 2.15226. This is a swing trade. We only had 5% of our normal size because with pound to Aussie, it's so volatile. The average this thing moves in a single day, it can be as much as 250 pips. Or it is actually the average, 250 pips, 240 some odd pips. So we're risking, somewhere in that vicinity. So we only had 5% of our normal size. We made 130 pips or 6.5 on a size adjusted basis. We were trying to hold it and hopefully clear through this 2.17 level, but after, this is a 30-minute chart, after several hours of bumping up against it, it was obvious there was a seller there. So once it started to sell off pretty good, we gave it somewhere in the neighborhood of 50 pips off of that high, off of that 2.17 level. Took us out. And you can see what it did. It came all the way down to 2.16, made another run at 2.17, and that seller is just there. It's a big seller. We probably should have been looking to go short it, but the long-term trend on it is higher, so you don't want to fight the long-term trend. It would have been a great trade to take it short, but it's not our thing. U.S. dollar, Japanese yen. This was a scalp, but not full, because we were risking more than we'd be willing to make on a full, or to lose on a full. So we had 30% of our normal size, 120.74. This was last night. It actually went against us pretty much rather quickly, but not a whole lot. You're talking 10, 15 pips. And by the time we shut the computers off around 11 o'clock, about 11:30 last night, well, we were down on it a little bit. So we just threw an offer out there just ahead of the 121. We actually put it at 120.89, not to get greedy or anything, make sure we could get out of this thing while we were sleeping. And actually, this is what happened. We got out 120.890, picking up 15 pips or 4.5 pips on a size adjusted basis. And you can see what it did this morning from 8:30, about 8:30 on. It started to run and it took off. Unfortunately, it didn't happen while we were watching it, because we really wanted to piece out of something like this. We'd be willing to piece out of it. But like I said, we woke up this morning and we were already out. But we'll take it. 11.0 pips on a size adjusted basis, and we'll move on to tomorrow. So that's it. We're going to wrap it up. If you're still trading now, good luck. If any signals come out, they'll be coming your way, and we'll do another video tomorrow, assuming we get some action. Have a great rest of your day.